It's a big noisy universe of stocks out there. Welcome to Goodbye or Goodbye. Our goal is to help cut through that noise to navigate the best moves for your portfolio. And today, we're tapping into the auto industry. Sticky inflation and elevated rates adding fuel to the competitive vehicle market. As competition heats up for auto sales, what's the best way to play the space? Well, I'm here with Michael Ward, Freedom Capital Markets Managing Director. Mike, it's good to see you.
Hey, Josh.
All right, so let's start with one name you do like, Mike. So we can call it up here. The first name we're going to like is General Motors, right? That's a buy. There's a few reasons for this one, Mike. So let's go over them. One is, we'll start here, your first bullet. Balance sheet is in great shape, Mike.
Right. And people forget, if you looked on Bloomberg or FactSet or anything, and you looked up General Motors, it would show that they had $100 billion of debt. That includes GM Financial. If you look at just the auto company, GM ended the year last year with about $5 billion of positive cash. So total cash, less debt.
Got it. Second bullet, Mike, let's go over this one. Surplus cash expectations in 24 and 25.
GM generated about 24% of its market cap in surplus cash from its auto operations. This year, you're going to probably see somewhere between $5 and $10 billion of surplus cash. That's operating cash flow, less cap spending. And their current market cap is about $45 billion.
All right, sounds pretty good. Final point here, Mike, in your bull thesis, attractive valuation. How come?
If you look at General Motors, I think there's this sentiment towards General Motors and the auto sector in general. Apathy is the best way to describe it. The least amount of interest in the group that I've seen in the 40 years that I followed the stocks.
Wow.
That's always a buy signal to me. General Motors right now is valued at under 2 times 24 and 25 on an EV to EBITDA basis. It should be trading 3 to 5. Over the last couple of years, it's been trading at 4 plus.
All right, so it's looking cheap based on those metrics. Before they pile in, though, Mike, what should viewers know about risk? What's the risk to the bull call?
Always risks with the autos. I always tell people on the autos, they're capital intensive, labor intensive, cyclical, low growth, highly competitive, highly regulated.
Got it.
If that doesn't scare you away, nothing does.
Great. All right, so that's the bull. Let's talk about a name, Mike, you don't like, right? So a name to avoid, in your opinion, Carvana. Let's go through some of the reasons here as well. First reason, scaled back growth plans.
Carvana's a great company. They've created a great brand on the used vehicle side of the market. It's a $1 trillion market, and they establish a brand name. What I worry about is valuation. Last year, they got into trouble with an acquisition, too much debt, not generating positive cash. They had to scale back growth objectives. It's trading as a hyper-growth company, and it's not. It had negative growth last year, single-digit growth in 24 and 25.
Second reason here, investors should think about, you said, inconsistently in making positive cash flow from operations.
Yeah, they're generating negative cash. Last year, they had some one-time items that produced $800 million of surplus cash, but this company is going to generate negative cash of $500 million to $1 billion this year. Next, they have a heavy debt load, and so, to me, that eventually will catch up to them.
Final reason you would steer clear of this, Mike, let's talk about it. Price volatility, obtaining cars and higher marketing spend.
Yeah, their brand name is key, and everybody's seen, the machines that they sell the cars with, the vending machines. You have to spend a lot of money marketing to get that point across. When they go out to get their inventory to sell, they have to buy the cars in the used vehicle market. Everything with COVID and shortages and everything else, it caused a lot of volatility. You look at the CPI data just the other day. A 1.8% decline in used vehicle prices is huge. You're talking about prices that usually go up fractions of a percentage point. They have to buy the vehicles at the market, fix them up, and then sell them retail. That creates risk to the model. A new vehicle dealer knows exactly what they're paying for a vehicle, and everybody else is paying the same price. If Carvana guesses wrong and buys a lemon, or used vehicle prices go the other way, they're going to be stuck paying more for inventory and make less money. All
right, final idea here, Mike, though. So you got to sell on this name, but what are kind of the upside risks to that call?
Look, it is a great brand name. They established a very good brand name. If we saw flattening out in used vehicle prices, we saw them get it together from an operating cash flow standpoint, and they were starting to generate positive cash, that would be a big plus. You already saw the earnings better than expected, and you had a big short squeeze. It had a huge short position in the stock. So between operating cash and the short squeeze, I didn't see the latest data on the short numbers, but I'm guessing a lot of that was cleared up with 4Q earnings.
Got it. All right, so Mike, let's sum this up for viewers here. So investors, you're saying buy GM with its attractive valuation, balance sheets in great shape, and the expectations in future surplus cash. On the other hand, you're saying avoid Carvana amid the disadvantages it faces, new vehicle dealerships, its inability to consistently generate positive cash. Thank you so much for watching Goodbye or Goodbye. We're going to be bringing you new episodes 3 times a week at 3:30 p.m. Eastern.